Mo, I wanted to come to you on this one. The relationship between yields and risk assets more broadly. That's been a choppy relationship through the year so far. What kind of relationship do you expect to be established going into year end?
Yeah, look, I mentioned this earlier. I think there is absolutely going to be sensitivity to a rising rate environment in certain sectors. If the equity market, the bond market generally leads, and we should, always think about the bond market as a good indicator of what's going to happen across risk assets. To my earlier point, I think, tech has always been very sensitive and continues to be sensitive to that. And when you think about the mechanisms of asset pricing, really it's a discount rate in future cash flows. Assuming future cash flows continue to meet expectation, that discount rate is going to be the one that's kind of driving repricing in the equity market.
Jack Caffrey, build on that. Is it a sector story or a broader index story because of the weighting of a particular sector will get hit by what's happening in this bond market?
Well, it's a bit of both, actually, in that as interest rates have fallen, we've actually seen effectively the whole world become a longer duration asset. Or I should say all financial assets become increasingly longer duration, which is more responsive to changes in rates and changes in the rate that those rates change. What you are seeing, though, is as rates have backed up, you're seeing, say, the financials start to work much better, the banks in particular. You've been seeing energy stocks working much better. And those are effectively, I think, confirming some sense that there is still a reasonable growth outlook and that the world just doesn't have to live in very long duration, very high expectation secular growth stocks. The challenge for us at the headline level in the index is that those secular growth stocks have such a large weight, tech at 28% of the S&P 500. You need to see a lot of rally in energy and financials to offset modest weakness in the technology sector at the index level.
We've been debating this all year. A high yield's good or bad for equity markets, depends where you sit in the equity market. The risk right now, the fear, Meg, and this is your world, that somehow the goals of the Federal Reserve and central banks elsewhere are overwhelmed by what happens with price pressures, that they don't achieve their goals on output, on employment, because they are overwhelmed by the former. Is that something that you're thinking about, maybe just a little bit more going into a new year?
It was Ben Bernanke who said that recoveries or growth periods don't just die of old age. Central banks murder them. And so that's always a worry that, the Fed will go ahead and tighten monetary policy too quickly. If you look at the past rate hiking cycles that we've had, the Fed's record on managing a smooth sort of landing is incredibly bad, actually. The Fed's hardly ever pulled it off, so you have to consider that that is always a risk. That being said, the Fed has been pretty clear that they're in the transitory camp on the inflation front. They've said that they'll signpost tapering very clearly. They've gone ahead and done that with hardly any market reaction.
Yep.
There's a good chance that they can go ahead and engage in tapering and eventually shrink the balance sheet without there being much of an equity market reaction, as we saw the last time the Fed tapered and shrunk its balance sheet. And it doesn't look like rate hikes are coming anytime soon. So I'm not overly worried about this, actually. I think the Fed has the right view on inflation, that it's pretty transitory. And if you look at structural factors, we're probably still stuck in this secular stagnation, global savings glut environment that we've been in for the past 15 years, and that's likely to carry on for a while. The only thing that will change that is if we get incredible amounts of investment and a boost in productivity growth, and that might happen, but it's not going to happen anytime soon.